Okay, the next thing I'm going to talk about is risk management at Freddie Mac and Fannie Mae. The reason I think it's important to understand that is that there are a lot of business processes involved that policymakers sometimes seem to forget about or take for granted. So there are two kind of errors that policymakers can make. One error is to sort of ignore these business processes. And so you see proposals, oh, let's create 10 Freddie Macs and Fannie Mae's, like 10 government guaranteed mortgage insurance firms, and let them compete with each other. Not taking into account that the Freddie Mac and Fannie Mae have spent a lot of time and effort and have made a lot of mistakes and learned from mistakes in creating risk management processes and acting as if any new company can just start up in this business without any institutional knowledge whatsoever. The second mistake that they'll make is they'll override Freddie and Fannie's risk management strategies. They say, "Oh, well, you're doing it wrong." During the housing boom, the override was to say, "Oh, Freddie and Fannie are rejecting too many good borrowers," and then, after 2008, Congress said, "Oh, we need to define what a qualifying residential mortgage is because you guys obviously don't have the right standards." So these overrides tend to be very simplistic. For the congressional rules or whatever tend to be very simplistic, and they tend to be pro-cyclical. That is, they tend to tell Freddie and Fannie to loosen their standards just when the market's getting overheated, and they tell Freddie and Fannie to tighten their standards after the market has crashed. So both ignoring the fact that there are these business processes or overriding these business processes are two common mistakes. So and I've talked about these business processes in some sense before, but I want to kind of summarize them here. And there are really two purposes for these business processes in some sense. One is you want to set some standards for loans. You want to say, what kinds of loans will we buy? You remember the 3 C's. So what your standards are for the borrower's capacity, for conscientiousness or credit reporting, and for the collateral. What's the value, the loan-to-value ratio in the property, and so on. And then the next question is how to ensure that loans fit those standards, because remember there's this principal-agent problem, which we've talked about again in a previous lesson. That is, you have somebody who's delivering loans to you or selling loans to you who may or may not have the incentive to deliver the right kind of loans. How do you create the incentives to deliver those loans? Okay, so let's review then some of the processes that Freddie and Fannie have. Very important is seller eligibility. Not anyone can sell a loan to Freddie Mac and Fannie Mae. There are eligibility standards, and the eligibility standards include mortgage industry experience. So industry experience, they have to demonstrate that. And they have to have capital. Why do they have to have capital? Because sometimes the lender will deliver a loan, sell you a loan, and you later re-underwrite the loan, realize that it really doesn't meet your standards, and then you want the company to buy back the loan. So that's one reason. They need to be able to buy back bad loans, that is, loans that don't meet your underwriting standards, and also that they need to have sort of a stake. Or maybe I'll put that they have to have something to lose. So if they have no capital, there's really nothing to lose if they go out and sell you bad loans or commit fraud. So there's no franchise value if they have no capital. So capital standards are important. Industry experience is important. There are business process requirements that you impose on sellers. For example, they must have their own quality control program. That is a program whereby they have people who check to make sure that the loan officers and underwriters have been following Freddie Mac and Fannie Mae standards. So you require that they have certain business processes that ensure that they will deliver the types of loans that you want. They've got to have properly trained and qualified personnel. Again, so the industry experience is for the executives, but then they also have to have properly trained and qualified staff who are doing underwriting, quality control, and so on. So not just anybody can be qualified to sell. And one of the things that Freddie Mac and Fannie Mae want to ensure is that there is some advantage to being eligible to sell. That is, if you're a loan originator, you ought to be able to make more money if you can sell to Freddie Mac and Fannie Mae than if you cannot. So you want that franchise to have value. So and at Freddie Mac there was a focus on evaluating each seller, and I think we ended up with sort of 3 tiers of sellers. There are sort of very large national sellers. At the time, things like Countrywide Funding would be an example of a large national seller. Then you had sort of more intermediate-sized sellers, often sort of regional banks. So a regional bank or a mortgage bank or a large regional mortgage banker. And then you had small local sellers. So these were local lenders. Now, typically you would have no brokers eligible. And why are brokers not eligible? Because they have no capital. A typical mortgage broker does not have capital. They cannot temporarily fund loans, and they can't pay to repurchase loans. So brokers would not be eligible to sell. So a broker would have to sell through one of these 3 channels, and it would probably be difficult for a local seller to qualify to sell brokered loans because they might not have enough capital. So brokered loans is often a separate eligibility standard. That is, if somebody, so you can talk about somebody who originates loans themselves, so they're an originator, or they're a seller of brokered loans. In addition, and for the seller of brokered loans, there's going to be a higher standard. They're going to have generally you're going to have to have had a longer track record with that company. You're going to require more capital. You're going to invest. You're going to want to know what their process is for dealing with brokered loans. Let me mention that one of the worst risks that you face as Freddie Mac or Fannie Mae is pure fraud. That is where the lender tries to abscond with all the money. So there may be no property at all. There may be a conspiracy where a bunch of people make up mortgage documents on non-existent properties or on properties where there really is no mortgage. So they sell you a phony mortgage, take the proceeds, repeat as many times as they can, let's say 20 to 50 times, get about 10 to 20 million dollars, and then disappear. That's one of the most painful forms of fraud you can have, and this is one of the, and it's one of the ones that you really try your hardest to avoid. So you try to do, again, you have the eligibility standard, so that if somebody has capital to begin with, they're unlikely to pull this off. I mean, if someone has $15 million of capital, that's they have a lot to lose by doing this. And the other defense against this is that, again, you have the seller who is qualified, so somebody does have capital. The fraud person will typically be someone at the level of a broker, that is, someone who's really not eligible to sell you loans directly, and they'll try to sell it through one of these channels, and then you want to make sure that these channels have ways of preventing that kind of fraud. So again, seller eligibility is sort of a key issue, and bear in mind that when you have someone like Freddie Mac and Fannie Mae, there can be political issues. Somebody can complain about not being an eligible seller, and so there can be some political pressure to become for Freddie and Fannie to allow somebody to be eligible to sell, and so on. But the sort of controlling risk at the institutional level, who you're buying loans from, turns out to be a key business process. Underwriting standards, fairly obvious point, but there are issues of how do you promulgate those standards. So there are a combination of guidelines, that is, written guidelines for sellers to telling them when to approve, when not to approve loans based on various conditions, and that can get very complicated. There's the automated underwriting systems that Freddie and Fannie provide. So if somebody puts the loan through the automated underwriting system and it passes, then Freddie and Fannie will buy it. If it fails, then the seller might have to come up with some justification in order to be able to sell the loan. Then there are exceptions. So there are basic underwriting standards, but sellers are always trying to say, well, this is an exception, you should take this loan. It doesn't quite meet your standards, but it has some other offsetting risk-reducing factor, so take it. So those are typically, exceptions are typically negotiated in the context of a contract. So Freddie Mac will say, well, you, seller X, or Countrywide Funding or whatever, can sell us loans that fail to meet our standards in dimension X, provided that there's some offset of some sort. It might be, maybe you offset it with a higher borrow income, but actually the typical offset isn't so much a characteristic of the loan that's an offset, it's a characteristic of the contract. So that will include what are called credit enhancements. And those can be various sorts, but basically what they are is guarantees by the seller that Freddie Mac's and Fannie Mae's losses on loans that contain exceptions will be limited by some way. So maybe the seller will put up, let's say, an escrow account that's good for 3 years. So if any of these loans default within the first 3 years, Freddie Mac and Fannie Mae can pull money out of the escrow account to pay for the default. And these sort of credit enhancements serve two purposes. One purpose is they just reduce the financial risk of Freddie Mac and Fannie Mae, but more importantly, they show that the seller is really standing behind the loan. The seller, knowing that the seller is going to be on the hook for part of the cost of a loan default, means that when the seller creates this exception and makes a new rule that maybe is more lenient in terms of underwriting, that they must genuinely believe that they are not increasing the risk by creating that exception. Otherwise, they would not put up the credit enhancement. So the credit enhancement you can think of as sort of an intermediate case between the seller taking all the risk on the loans and versus the seller taking none of the risk on the loans. There's some risk sharing between the sellers and Freddie Mac and Fannie Mae when there are these credit enhancements, and that's often the way that exceptions are approved, through this credit enhancements. So to summarize, we've got the underwriting standards, which set the basic standards for loans. Then you get exceptions, which usually are part of contracts and often are accompanied by credit enhancements, so that the net result is that when a loan has some exceptions to it, or when a contract allows some exceptions to underwriting standards, sellers and Freddie Mac share more of the risk than under the standard contract. And those are the sort of the basic tools for ensuring that Freddie Mac and Fannie Mae can control the standards for the loans that they get while allowing some exceptions, and how they can ensure that the loans fit those standards, because it's in the interest of sellers to remain eligible, and to remain eligible they have to show that they consistently sell loans to those standards, and that they have the capital to back up their loans, and moreover that the fact that they have capital means that they have something to lose should they lose their eligibility.